So you want to retire early, but how do you actually invest your money to do this? Well, I see a lot of people use a band-aid solution when it comes to investing for retirement. They invest their money with a financial advisor with high mutual fund fees, or they try to invest their money on their own by buying random individual stocks without a clear investing strategy. Now, if you do this, you might not notice a difference in the short term, but as you get closer to retirement, you might realize that you don't have enough to retire early or retire at all. And this is why you need to have the right investing strategy today, so that you can retire while you still have the energy to move and enjoy life. And that's why, as a personal finance coach, CPA, and someone who's helped over 100 plus clients learn how to invest their own money, in this video, I'm going to share the 3 investing strategies that you need to start doing today so that you can retire young, not old. Let's get into it. A lot of people think that investing is super complicated and needs to take a lot of time. But what if I told you that investing could actually be really easy and not time consuming at all? You know, in the media, investing is often portrayed as something that's super risky, dangerous, and sexy. But in reality, investing is actually really boring. There are many investing strategies that range from low risk, low time, also known as passive investing, versus high risk, high time, also known as day trading. And now most people will not and should not become day traders, because day trading is literally a full-time career. If you want to be a successful day trader, you need to spend years learning how to read and understand financial information and market data. Instead, in my opinion, the best investing strategy, especially for beginner investors, is a passive investing strategy. This is where you invest in low-cost diversified funds, also known as exchange-traded funds that track the entire stock market. And by doing this, on average, over the long term, you can expect a 7 to 8% rate of return per year. Now, some years might be higher, some years might be lower, but over the long term, you can expect a 7 to 8% rate of return per year. And implementing a passive investing strategy doesn't need to be complicated or require a lot of time. I teach my clients a simple passive investing strategy where they spend less than 1 hour per month in order to successfully implement this strategy. It might take a little bit of upfront work in order to learn and construct your stock investment portfolio, but once you have your portfolio there, all you need to do 1 to 2 times a month is to buy your portfolio. And that's it. One of my clients, Brianna, thought that investing was super risky and complicated because she would see all of these guys talking about investing, of how much money that they made and how much money that they lost. But after working with me, she realized that investing is actually really easy and not risky at all if you actually know what you're doing. What I like to say is that investing is just like swimming. If you swim in the ocean and you don't know how to swim, well, that's pretty risky. But if you learn how to swim and you swim in the ocean, that's not risky at all. And it's the exact same thing when it comes to investing. Your risk when it comes to investing is relative based on your investing skill level. And that's why if you want to learn how to invest your own money, you first need to improve your skill level when it comes to investing. And if you want to learn how to do this, but you just don't know where to start, then get started with my free course, Get Good with Money. To get it, just go to michaelleekim.com/start. So now that you know the best strategy to invest your money, when is the best time to actually invest your money? Should you invest when the market's doing good, bad, or maybe it doesn't matter? Well, a common mistake that a lot of people make is that they invest when the stock market is doing good. But when the stock market is doing good, you're buying things at a premium, aka more than full value. And I don't know about you, but I like my discounts. And so the best time to invest your money is actually when the stock market is doing bad, because then you're buying everything at a discount. But then how do you actually know when the stock market is doing bad? Well, the thing is, it's often hard to tell, because whether the stock market goes up or down often isn't based on logic. Instead, it's based on what people expect the stock market to perform. For example, if people think that the stock market will go up, more people will invest their money and then the stock market will go up. But if people think that the stock market is going to do really bad, they're going to pull out their money and then the stock market is going to go down. It's a self-fulfilling prophecy. And oftentimes, humans aren't always logical and rational, which is why it's so difficult to predict whether the stock market will go up or down. And that's why the best time to invest your money actually doesn't really matter too much, which is why a dollar cost averaging strategy is so effective. A dollar cost averaging strategy is when you invest a certain amount of money regardless if the stock market is doing good or bad. And the benefit of this is that sometimes you'll buy when the stock markets are down, which is good. But other times you'll invest when the stock market is high, which is not great. But over the long term, it averages out. For example, let's say you buy Apple at $100 in January. Then in February, you buy it at $120. Then in March, you buy it at $80. But over the 3 months, the average cost is $100. A dollar cost averaging strategy was really effective for me during 2020 when the stock markets were really volatile. Because even though logically I knew that I should be investing my money, it was really hard to do this when the stock market was going up and down so quickly. And so I just implemented a simple dollar cost averaging strategy where I invested between $1,000 to $2,000 per month regardless if the stock market was doing good or bad. And because overall the stock market was doing pretty bad, I was able to buy a lot of stocks at a discount. And then when the stock market returned, my investments were doing really good. And so all you need to do to implement a dollar cost averaging strategy is to decide on the amount of money that you want to invest either once or twice a month. And then regardless if the stock market is doing good or bad, you're going to buy your investment portfolio. And this way, you don't need to stress about, is this the best time to invest? Because it doesn't matter in the long term. But I'm curious, have you ever tried to time the market and were you successful or unsuccessful? Let me know your experience in the comments below. Recently on my Instagram, I did a survey asking you whether you should be investing in low or high risk investments for retirement. Over 80% of you said low risk. And let me share with you why this is a really big mistake. The problem is if you invest in low risk, low return investments for retirement today, you probably won't have enough money to retire early or retire at all. For example, let's say you want to save $2 million for retirement over 30 years. If you only invest in low risk investments at a 2% return per year, you would need to save over $49,000 per year or $4,000 per month. And now I think most people would find this amount difficult to save. And this is why if you're in your 20s or 30s, you actually want to be investing in high risk investments for retirement so that you'll actually have enough money to retire when you want to. Once again, let's say you need to save $2 million for retirement in 30 years. And if you invest in high-risk investments with an average rate of return of about 8% per year, you only need to save $17,000 per year or $1,400 per month. Now, this is a lot easier than trying to save $49,000 per year or $4,000 per month. It's less than half. And now the reason why you can invest in higher risk investments for retirement is because there is a longer time horizon. If you're in your 20s or 30s, you have 30 years until you actually need this money to retire. And so if the stock market crashes tomorrow and your investments go down, that actually doesn't really matter to you because you still have 30 years to wait until the market recovers. And the average market recession only lasts between 1 to 2 years. But the thing to note is that as you get closer to retirement, you actually want to rebalance your portfolio from high risk, high return investments to low risk, low return investments. And what this allows you to do is to grow your money while you can take the risk. And then as you get closer to retirement, you now shift your portfolio to lower risk investments because you'll be needing this money during retirement. In 2020, one of my family members wanted to buy a house, but they had their money in high risk investments. And so when the stock market crashed in 2020, they didn't have enough money to buy their house. And this is why the general rule is that with short-term goals, you can't take that much risk. But with long-term goals, you can. That being said, what you invest in and how you actually invest your own money will look very different based on your specific financial situation and goals. I've worked with over 100 clients, and each of them invest in different things because they all have different financial situations and goals. And so if you want my eyes on your specific financial situation to help you implement an investing strategy to achieve your financial goals, then apply to get a free financial assessment with me. Every few months, I open up some spots and we always sell out. And so if you want to apply, just go to michaelleekim.com/assessment. There's a lot of misinformation and mistakes that people make when it comes to investing, especially for retirement. And in the short term, these mistakes may not make a big difference, but over the long term, this can literally determine whether you're able to retire comfortably or retire at all. And this is why you need to set up the right investing strategy today so that you can set yourself up for success in the future. And so if you want to learn how to start planning for an early retirement, including exactly how much money you need to start saving today to be able to retire early, then watch this video right over here.